Well, good afternoon. Good afternoon and welcome to another Webinar Wednesday hosted by the Cal State Bakersfield Small Business Development Center. This is webinar number 311 on March 6th, 2024. And I'm Kelly Bearden. I will be your host as always, or usually. And today I will be your presenter. So we're going to be talking about getting your small business loan ready and a lot of the things that go into deciding what is loan ready. Lending is a very complicated field. It's hopefully will demystify some of the complexities and give you some resources and some direction on where to go to get that capital needed to start, grow, or expand your business. And what is up today? March the 6th, 2024. Well, people get ready. Get ready, people. Get loan ready, that is. And so we're going to get into trying to demystify some of the processes, some of the conceptions, some of this thing that wraps around what it takes to get a small business loan. So we're going to be getting ready and talk about a lot of the unique situations that pop up, a lot of the unique programs, and some of the things that might help you and make a difference in getting funding for a small business. We're going to talk about some of the fantastic financial resources that we go through and we talk about. We'll jump in, and as we have been doing, talking about the employee retention credit. The ERC has an amnesty program that expires later this month in just a couple of weeks. March seems to be the expiring month for a lot of pandemic era programs, and this is one of them. The amnesty program will allow you to return some of the money that you might have received from the ERC, 80% of it, in exchange for not going through a lot of the onerous details, or if you figured out that you might not qualify. We have an update today on the beneficial ownership information, and that is the program that falls under the veil of the Corporate Transparency Act that requires business owners to submit information. There's been some changes. It seems like there's changes every week on that, but we're going to spend a little bit more time. I plan on talking a little slower today, and we'll get through a lot of those things that make a difference. We're going to have an economic corner today because there was some big news this morning, or some news that at least supported our people get ready, get loan ready. And we'll talk about some interest rates and some of the things going on with interest rates in our economic corner. We'll get into our capital quarter that we have. Both of these are regular weekly features on Webinar Wednesday. Capital quarter, it's been absent, but we're really making up for that today with a detailed program. Briefly, we'll hit the community calendar very briefly. And our COVID EIDL hardship and PPP forgiveness just recently ended, but still want to encourage you that if you do have an EIDL hardship, an economic injury disaster loan, if you have an issue with the payments, to please reach out to the SBA. You really don't want to get behind on that, and you really don't want to go through a possibility of missing out on any future government lending and other programs that would go along with that. So the hardship, but still a lot of times you can go in and you can go into your portal of your EIDL loan and talk directly to SBA and try to get a payment plan that works better for you. As always, we'll take live questions today. Live questions answered later. We'll have resources. Our producer, Maureen Busherdang, will be adding resources into the chat box, and she'll be chatting it up in there. And, let's do a poll today. So a lot of, really serious content today, a lot of really technical. Let's go with a lighter poll today. And it's a poll I've been meaning to ask for a while now. I'll tell you, I read this 11 months ago, and I said, I got to have a poll question on this and see if our audience translates to the national poll on this same topic. And I'm talking about this poll question that we're going to ask. So our poll question that we are going to ask, our first one is just very basically, what is your level of happiness? Is it pretty happy, very happy, or not too happy. So about 11 months ago, it's taken me this long to get to this. It's almost an old dated poll in 2023. The Wall Street Journal came out with an article on, happiness. And, I think it's kind of, maybe nationally we're happier than most people. And I've been meaning to get to this particular poll. So I'm asking you now, what is your level of happiness? Are you pretty happy? Are you very happy, or are you not too happy at all? So we have 70% of you jumping in. I know the other 30% have a level of happiness. So well, I'm going to hold out just a moment or two longer and get one of those 80% participation rates, and just need one more person. Right on the fringe, on the cusp. Okay, we're going to end the poll with 75% of you participating in that particular poll and find out how happy we are. And with our poll, 57% are very happy, 35% are pretty happy, and 9% are not too happy at all. Well, that's fantastic. That is absolutely fantastic. In 2023, based on a WSJ NORC poll of 1,100, nearly 1,100 adults conducted this same week a year ago, the margin of error of 4%, 58% of the people were just pretty happy. And we have 57% that are very happy. Also in that poll, it showed that nearly 30% were not too happy. Here in Central California, only 9% of us are not too happy. And as far as very happy, 12%. So we are a happy bunch of people. I'll tell you, we might have to change this from Webinar Wednesday to Happy Webinar Wednesday. That's a great result. Thank you for making me happy and showing how happy you were. Just ironically, in 2018, the number for not too happy was only 11%, and it rose dramatically over the last 5 years to 30% on the national poll. So thank you for bringing that. Got one more poll question, and we'll stick with the whimsical topic of the day and keep it a little bit on the looser side of things. And we will stop sharing that particular poll and move to poll question number 2. And this is a little bit of a music poll for a change. We haven't had these in a while. And recently, the band U2, the Irish band, recently concluded a series of 40 concerts at the Sphere, a new venue in Las Vegas. What was the gross amount of those concerts? Just came out today. 40 concerts, about a 20,000 seat venue. 40 concerts, was it 80 million? Was it 248 million? Or was it $20 billion? And we're up to nearly 50% of you participating. U2, the Irish band, 40 concerts. 40 concerts grossed what? 80 million, 248 million, or $20 billion. We've got 63% of you participating right now. Going to go ahead and give you one last moment and end this poll and share the results with you. We have 66% of you participating, and look at that. You guys nailed it. 248 million is the correct answer. 2/3 of you were correct. A quarter thought maybe 80 million. Well, that is, 2 million per concert. It sounds like a lot of money to me. And 10% of you were kind of fooled by inflation these days and thought maybe $20 billion. So thank you so much. And let's move along. So today we're going to be talking about a lot of different things. And first, if you're familiar with Webinar Wednesday, I'm on for 15 or 20 minutes giving details. And one of the programs we've been talking about is the Employee Retention Credit Amnesty Program. Now, this program is only going for another couple of weeks, but employers can return 80% of the money and reduce any civil penalties or any other penalties that they have in filing amended tax returns which are almost certain by taking the tax credit. It almost forces you to go back to 2020 or 2021 with amended tax returns, both for your entity, be it an LLC or a corporation, or your personal tax return in order to do that. So to qualify for the 80%, you can't be under criminal investigation or an employment tax audit. You have to the 22nd, so just 16 days left. You don't have to repay any interest. And one of the things that we talk about is that by taking this credit, you have to reduce your wages on your tax return by the amount of your tax credit. So if you, that is really where you need to go back and amend the return, because generally in almost all cases, you will have deducted all of your wages against your income to pay the possible lowest tax. So in this agreement, they want to impose civil penalties, and but they're not providing amnesty for any criminal prosecution if you were very, very bad. So there's a little bit on the ERC, on the Corporate Transparency Act, the latest on the business ownership filing. Well, you know, this is, of course, this new law that affects 32 million closely held companies. The corporate tax, the CTA, the Corporate Transparency Act, was enacted to curb illegal activities such as money laundering and other areas, trafficking, a lot of different areas, to where the government was looking to try to shut down some of those organizations. And in doing so, everybody gets to participate. So the filing deadline for businesses that started at the first of the year, if you were an LLC or a corporation and other entity, and you started business on July 1st, you have until the 31st of this month in order to actually get the filing done. For those businesses that were in business before 2024, that has been moved till later in the year, and penalties can be as much as $500 per day. That's $15,000 per month in my calculation, except for leap year, of course, or leap month. Okay, so the act affects with those businesses generally if you have 20 or fewer employees. If you own 20% of that. There was a recent court challenge in the last week or so that ruled the law unconstitutional. However, many expect the government to appeal and maybe win on appeal. And if they do, it will be back. Reporting is done through the government's FinCEN website. It includes providing personal information, that's your contact information. And what it's designed to do is to fully identify the ownership of these entities. So here at the SBDC, at least me personally, I believe in the when in doubt file. So owners that need to file the report soon are those that started on January 1 with their new entity. And really where I think we're going to see a lot of issues that come up in this thing is that once you're talking about change of ownerships, like if you want to sell, if you have a 20% partner who leaves the business and one that comes in, all of those are going to reflect a new filing. So get it filed and then at least get that thing going if you are in the need to do so. And you very well may be. Okay, our economic corner. Had some good economic news today. Our economic news, Fed Chair Jerome Powell said officials want more evidence that inflation is slowing before cutting interest rates. He says that there are two issues. He said that this morning before the House Finance Committee. This morning, he said that the two issues are if they move too slowly to ease and the economy crumbles under the weight of higher interest rates, which is a problem with recession that we didn't have last year with the growth of 3.1%. And the other is allowing inflation to become entrenched well above the 2% threshold that they have set for inflation. Currently, it's at 3.1%, but they want to get it down to 2%. So in doing so, it might be behooved that, you know, they might wait, but they are projecting to do interest rate cuts this year. So how does this all matter to what we're discussing today? And the Fed does influence small business loans. For example, if the Wall Street prime is 8.5%, Many SBA loans, for example, are tied to the prime rate plus a percentage that can be anywhere between, 0 and 3%. Most commonly, we see between 1.5 and 2.25%. So at 2%, say over prime, that's 10.5% is your interest rate. SBA loans are tied to the prime, so they go up and down depending on what the prime does. So your rate can actually go down if you have an SBA loan if they start cutting it now. So they are kind of driven by what the Federal Reserve does and says. Fixed asset loans from SBA, like the SBA 504 program, those reflect lower risk and are a lower interest rate and can be fixed over time and can be a lot cheaper than the rates that we just talked about. So that's a theme that we're going to hear a lot today is interest rates are generally set based on the amount of risk that the lender or actually will take on. And lastly, on Economic Corner, our resident economist, Dr. Mark Evans, returns as soon as next week. Some other things coming up before we hit the finance section is going to be starting a business boot camp, which did start this last week if you're looking to start a business, and you'll see the startup cost and funding. And it's really nice going through this particular program. You can probably catch last week's edition, yesterday's edition, and catch that and get caught up. But it gives you a good solid basis for starting a particular business. Social media webinars are available. There's still a couple more of those in the series of 6. Some of these sessions are between an hour and a half and 2 hours on a variety of different topics. It looks like the topic coming up next Tuesday is going to be overall best practices in community building. If you want to run a daycare, talk to a nurture coach, 916-919-1353. Some great opportunities to get the business side of running a daycare business in your home and actually being profitable and making money at it and helping a lot of other people as well. Our free HR hotline, there's a list of the counties and phone numbers. Take a screenshot real quick if you want to. And if you want to call, if you have a question, the California Employers Association is available to provide help to employers at no cost through that hotline. Our YouTube channel, our CSUB YouTube channel, over 400 subscribers. Thank you for all of you out there that have subscribed to our YouTube channel. And our YouTube channel is the home where our webinar Wednesdays go. We might have some coming up that might not end up there because when we start bringing in some national speakers, a lot of them are reluctant to have us put their content on a public site. So we might have to move that to a different site, but for now, about all of our webinars over the last 4 years or so are on there, maybe with the exception of 1 or 2 when somebody forgot to push the record button, and that would be me. So our capital quarter, for the last year or so, we've had a weekly feature that we don't talk every week about. And then some weeks we're going to talk about it for the majority of the hour, and that is our capital quarter. And we came up with the factors that can limit your ability to raise capital. So this looked like a great place to start on getting capital ready, on getting loan ready, and actually getting there. And some of the suggestions we've talked about over the last 9 months or so is looking at a thing as simple as a debt to equity ratio. There's a couple of ratios that kind of really make things important and make it very difficult for a lender to actually approve your loan. And they will look at these financial ratios. Your debt to equity, so the amount of debt that you already have in your business to the equity or the net worth that you have generated, is a financial ratio they look at. Another one could be your business could be limited by your business liquid FICO credit score. Got into this a little bit last week when we had Henry McGunn on, and he talked a little bit about business credit. So, but it can be a new source of way of getting credit is looking at improving your business credit side of things. Unable to demonstrate a positive cash flow. That is really a big one because, cash flow is what drives so many lenders. If you can demonstrate that you have cash flow, either on a projected that is a projected basis for your cash flow, or on a historic. Ideally, a lender is going to want to see historic cash flow, and that is going to come from tax returns. That is why, as part of the loan packet process, they will get into tax returns. So also, leverage equity from grants and crowdfunding campaigns and other source to debt. I think this is really underutilized, and really the leveraging amount. For example, there are grants still with the City of Bakersfield program. And if you were able to get one of those 10, 25, or $40,000 grants, which are still going on from the city, there's an opportunity to leverage maybe another micro loan from that. If you've had a crowdfunding campaign, and I know crowdfunding is kind of a difficult topic to really get your arms wrapped around at times, but if you could raise crowdfunding money, which the SBDC has helped clients do, you can actually use that in order to leverage more debt. We talked a little bit about the EIDL issues and some of the long-term benefits of having an employer disaster loan, an SBA EIDL loan, and let me get this acronym correctly, EIDL, of course, we all know is the SBA disaster loan. And so there are long-term benefits from having 27 more years of that debt in front of you at 3.75%. A lot of times in selling a business, for example, we talked about. Minimizing taxes can be a long-term funding issue. I know it's tax time, and I know nobody wants to pay more tax than they're legally responsible to pay. But oftentimes, by beating up the bottom line so much, it doesn't show that cash flow that lenders are looking for on your tax return. The other thing that we talked about over the last few months has been understanding all of your options that are available. And hopefully we'll get into some of those options today and identify and plan borrowing opportunities. I think this one is underutilized as well, because I think too many people want cash now. It's like that Wentworth jingle on TV, H.R. Wentworth, whatever. Give me cash now. So I think that when you get past the cash now thing and realize that this process is going to take a few months anyway, and oftentimes, 6 months, 12 months, 18 months pass quickly in a business life. And oftentimes, if you are not ready for cash, you're not ready to be loan ready now, it's really good to get on the track to getting loan ready. So we'll know and identify the loan requirements. One of our former presidents once said it's the economy, stupid, when he was running for re-election and was reelected. That was Bill Clinton. And really, the economy, the general economic conditions, the conditions of the general economic terms, what's going on in New York and other places around the country, can affect your ability to borrow. And with the growth that we had last year, we did not have a soft landing recession that was anticipated that would have tightened down borrowing. Sure, the interest rates have worked to clamp down borrowing some, but not as bad as a recession would have done. We talked about setting up lines of credits, and there are term loans where you pay for a loan over a specified term, and then there are lines of credits which are beneficial for many people. And oftentimes it's best to set up the lines of credit when you don't need the money. I know that is an oxymoron of lending. People tell me that all the time. Gee, the bank or the lender only wants to make a loan to somebody that doesn't need the money. There is some truth to that, because it shows that you have the financial wherewithal at the time. But there are great times to set up line of credits when bad economic times might be coming, when you might see that there could be a need for that later on, and it's just an added layer of safety for your particular business. We also thanked you for the Federal Reserve's bank survey, for those that took that. And we are in the process of getting our own data that we're going to go over. For those of you that did not take or know about our Federal Reserve Bank survey, it's a national survey done by the Federal Reserve Bank, and they put out the credit survey of credit borrowing for small business. And what we're getting this year is a subset for Kern County. So yes, we have enough people, enough sample size to get our own data that we will share and compare it to the national level. We already know we're happier. So now I think we're going to find that it's going to be easier for us to get money. So we also looked into demonstrating long-term value, and that is really looking at the long run for your particular business and seeing that longer value. Oftentimes loans will be in the form of 5, 10, 15, 30 years. 30 years. So how are you going to provide value over the long term? And how is a longer term note? By the same token, a lot of assets, when we get into purchasing or actually buying assets and then financing them, is we really need to find a way to make sure that we are doing that over the appropriate term. For example, real estate needs to be purchased over 15, 20, or 30 years to ensure smooth cash flow. Shorter term assets that wear out in 3 to 5 years need to be purchased with a 3 to 5 year loan. And then when that is done, if you need the asset again, purchase another one. So matching the livelihood of the particular asset, the length of how long you're going to be able to use that asset to the program is something a lender is going to look at. And we looked at some of the other things as far as from ag lenders. So let's get credit ready. You know, one of the things is I am going to stop sharing for just a second and reshare this other document with you. Is at the SBDC, we have this one document that we call our capital assessment form. Now, the one thing that we like doing the capital assessment form because it gets a client's financial information on paper and kind of really looks at our options then. And this is something that we've gone away from a little bit with a lot of the pandemic borrowing and other things, but it's something that I think is a great tool for our advisors in working with small businesses. The form was initially designed by Dr. Kirk Clark, and I provided some enhancements. And it just kind of goes through a lot of in one page, a lot of the information that a client is going to have in their particular business and really show us what options are available from a funding perspective. The funding perspective is so wide with both debt and equity, is that we really need a lot of the information in order to assist you in making the right choice for your funding of your small business. So it's going to get into a lot of the things that lenders get into. It's going to get into like number 6, what is your legal form of business? In the last year, your revenues, what were your revenues? Line number 9, and in line 10, even more important was your profits. I love it when people tell me that their sales went up 30%, but if their net profit went down 10%, I'm not happy at all. Put me in the non-happy in that. I'll go back and I'll change my vote and I'll be not happy. So sales going up, but our profits going up as well, something we really need to look at. We're looking at other things. Is the client trying to purchase an existing business, for example? Are you a startup, an existing business? So many different things here, including what is your credit score? You know, number 18 is never a fun question to ask, but if we know going into a particular funding situation, if a client's had a bankruptcy, we can work with lenders that might work in that particular area. We could also look at some of the options that are not ideal options, such as if you're purchasing real estate, potentially you might want to look at a hard money lender and maybe paying more for interest if you are getting a good enough deal on the front side of things. So we also like to know how the funds are being used because we know the lenders. And the best way that we can work with you is to have the information and work with your particular lenders. So our capital assessment form is an outstanding way of actually doing that. Let's talk about, you know, some of the basics that we're going to get into. So getting ready is involving some basics. And the first one is that it's subjective. You know, what I think is a great business loan, I could have a lender in here and he might say, well, you know, it's not a great one. It's a pretty good one. So it's going to be subjective. So one loan does not fit or serve all. And really, you know, no scorecard really exists. I've only seen one instance where a lender actually had a scorecard on how they would rank and go on a 1 to 10 scale, add up the number. If you were over a certain value, then you were funded. It's subjective. You know, people are going to be different. People are going to want to see different things, but subjectivity isn't bad in the least. And the fact that no scorecard, many other factors are considered. So when they go subjective, they'll go with a thing that many of you might have heard of, and those are the 5 C's of credit. And that is going to include not only credit, but condition and capital and collateral and character. And a lot of these factors are going to be kind of things and stalwarts that the bank is going to look at. For example, let's start in the middle with capital. Capital is defined here as the amount of money that you put into a particular deal. It's really hard, not impossible, to get a deal with zero money down. Lenders want to see some interest on your part in this, not only from the standpoint of starting, but also in continuing this particular business. So with our 5 C's, capital is going to be the money that you need to put down in order to secure a small business loan. And again, you know, depending on the size and the program and the lender, if the lender's a for-profit lender, a credit union, a small bank, a big bank, a private lender, there's a lot of different factors that go into this. And they have different rules of thumb, for example. So in capital, you might be putting down somewhere on say a $50,000 loan, maybe $10,000 of that. You could have raised that in a crowdfunding campaign, and that counts. So you could have got a grant that you don't have to repay. That will count as well. It could actually be $10,000 worth of equipment that you're putting into the business that is not cash, but will be personal assets converted for business use. So there's your capital. They'll also look at your character. So they'll look at a variety of different forms. The SBA has a Form 912 that, you know, ask a variety of questions regarding your background. It's the background check part of the loan process. Does it necessarily disqualify you if one of these C's don't actually work out perfectly? No. But at least knowing ahead of time where your weakness is in your application is being able to address it, not only with documents that you provide to the lender, but with the lender. Very important point there. Knowing and actually understanding where your weakest parts are will help you in the long run. So we talked about capital and a little bit about character. We talked a little bit about condition earlier when we were talking about the condition of your particular industry, the condition of the general economy. Are we in recession? Are there good times ahead? Are interest rates moving the right direction? We'll look at a credit analysis, and credit can be the analysis part of things, the numbers, and also collateral, everybody's favorite C, collateral. And those are assets that you're willing to pledge. And I've seen more deals get done with less collateral in the last 5 years than I saw in the previous 15 years before that. So a lot of these areas are moving to a softer area, depending on the lender that is being used and the scope and the focus and the intent of that particular lender. Very important concepts. You know, in business loan, size matters. You know, a $10,000 loan is completely different from $1 million loan. You'll go through a different process. You'll go through a different source. There'll be probably more documentation. There's still going to be a lot of documentation on a $10,000 loan. The process is going to take longer than you want it to take, but there are lenders out there, particularly lenders such as CDFIs, which are credit, CDFIs, yes. Community Development Financial Institutions, thank you. And others that are nonprofits that are much more willing to make loans to more members of our community that are typically considered underserved. So, and oftentimes they don't have, you know, your 5 C's might not be, but you got 3 good C's and a good business idea. And you got a plan and you show how it's going to be paid back. And the other thing to remember is another key basic is that Most loans go through an underwriter or an underwriting committee. They could be approved by boards if they're smaller entities. So really, your application is being taken by a person who is not going to have the capacity to approve your loan. Another area I see a lot of small businesses fail in, and that is targeting lenders who really are not operating in the space that their business is operating in. And maybe it's even business loans. Oftentimes I hear, it is too often I hear somebody will say, gee, I've been with this large bank for 26 years. I'm sure they'll give me a small business loan. Your 26 years of loyalty and service and providing, stability to that larger lender isn't going to matter on a single transaction loan like this. They're going to look at it just like you were with them for one day. So really, loyalty is not something that really translates well in targeting your lender. It's really looking at lenders that are actually operating in a particular size as well. We work with lenders who don't want to see a deal that's less than $1 million. And we have some that really want to do deals between $25,000 and $300,000. So it's really working in a space and targeting a lender that really meets the size and need of your particular application. The other thing is, I like to say that people going through a small business loan will do it once, twice, maybe 3 times during your entire business life. It's not like a lot of things like social media marketing where you need to learn the concepts and employ them every day. It's not like a lot of other areas that you have to put that hat on in your business on a weekly basis. Getting a loan is something that is going to be something that is only done a few times during your life cycle of your business. So the point is that you don't need to learn everything. You don't need to know everything. You need to get help from people that know how to do it, though. And that is where the SBDC really, I think, really does an excellent job of knowing what their clients need and get assistance from those that deal with it on a daily basis. So the other thing is that, you can learn, but you need to understand what it's going to take to get a loan approval. And if you're not going to get loan approval, because not everybody does, and the percentages are higher of those that don't get loan approval that get it, is you've got to understand that there are a lot of alternatives to getting a small business loan. We're not going to go through those today. That's not the focus of this, but we have addressed them in previous, and we will address them in future. The content that we have to go through today is just too great to really get into that. But what I want you to do on some of these basics is to think long term. So let's get together on putting together a loan package. What is the information that is going to be required? What is the lender going to want to see? And they're going to want to see basically, usually a business plan. I like to think that, and we'll touch on a business plan in a second. There's a lot of options for business plans, depending on, again, the size of the loan you're getting. If you're getting $1 million loan, you better have a substantial business plan that shows how that's going to be repaid. If you're getting something much smaller, like say a $5,000 or even a $20,000 loan, the financials need to be far less intricate. They need to be less detailed, but they still need to demonstrate that the business is going to make money. It needs to demonstrate that there's going to be cash flow that comes off that particular business that repays that debt. And a couple of pages tacked onto a business plan is really helpful. They're going to want to know the owners, and anybody over 20%, often sometimes even 15%, there's going to have to provide financial information on this particular deal. I've seen some deals where actually people would take a lesser percentage. They were investing in the business, and really, rightfully so, they would be entitled to maybe 20 or 25% of the business. But they said, I'm only going to take 10% because I don't want to get into a situation down the road where I have to provide my financial information, and I might also be asked to guarantee the loan later on. So it gets them out of, here's my original investment. I'll take a lower percentage of ownership in order to do that. Use of funds. So, your lender is going to want oftentimes a detailed and receipts-driven use of funds. Um, you really need to know exactly what you want going in. Lenders don't want to know that, you'll take as much money as they'll give you, and you're going to use the funds depending on what your particular project, how many funds you get or how much funds you get. But really showing a use of fund and coming in with a conviction on a dollar amount is important. Now, sometimes a lender will counter, and you will be able to work around some of the things you were planning on funding and saying, okay, I can work with that. But really knowing what your business can afford to cash flow based on your future sales. Oftentimes these funds are going toward increasing sales, generating higher revenue. That's what a lender wants to be part of. Global cash flow. And really, global cash flow, I think you've heard me talk about cash flow. Global cash flow is the same, except it takes into all considerations. It doesn't only take cash flow from your particular business, it takes in cash flow from your personal situation. If you have a spouse that works outside of the business, global cash flow takes into that salary into effect. It can take in any investment properties. If you have, say, a rental real estate, for example, and that's cash flowing positive. It can actually be used for that as well. Your credit, obviously, your credit history is going to obviously always come into package, and they're going to look at your particular credit. They're going to look at the collateral, and I think it's always great to identify your collateral up front. Always, it's best to use assets that are being purchased, but oftentimes we'll want a loan for permanent working capital. Okay, what's permanent working capital? Well, permanent working capital is that money that you need in the bank in order to run a business. It gives you the swings from when money comes in and money goes out. Permanent working capital helps you purchase inventory at certain levels. It actually helps you then make payroll. So depending on what your credit terms are, a lot of people get cash in their business every day. Some people have credit terms to where maybe the credit terms are net 30. So just working with that actual aspect of it is very important. So we talk about benchmarking, and benchmarking is basically, going and kind of charting your results and what the results are in your particular industry. For example, your lender will do that. Your lender can pull up information on, let's say, if you're a restaurant and you have 15 employees, you do $500,000 a year in sales, they can go pull up exactly what a restaurant like that should be doing financially. Then when they get your financial reports, they will compare how you are doing to your industry. And that is something that's always good to know before you go into that, because if you aren't compared favorably to your industry, you need to know that the money that you're getting is going to change that. So, and then all the lending resources, again, come back down to, people out there that are doing loans on a local basis, on a regional basis, and a national level. And really, it's really so much determined by the amount of money that you need. So the person that you've talked to all this long, you pulled in your package, your information, isn't the person making the loan. That's going to be the underwriter. So what are some of the options that are out there, and what is an underwriter going to look at? Well, they're going to look at it differently if they use traditional resources, including SBA and other sources. Lenders like SBA loans because, number one, there's a guarantee if something happens and the loan isn't repaid, that the federal government or actually more likely, other applicants in that particular loan program pay a fee, and those fees add up to cover the losses in the loan program. Also, with some loan programs, a bank could be in real estate at only 50%. So they're holding a $500,000 mortgage on $1 million piece of property. Last time I checked, that's fairly secure. So traditional resources are underwritten a little bit differently. A lot of the alternative lending processes that are out there is microloans by a variety of different entities. Could be a government entity, could be a nonprofit, CDFIs again. We have 2 credit union CDFIs here in Kern County, Alto One Credit Union and Valley Small. Another CDI, Access Plus Capital, works out of this, out of an office in Bakersfield. So there's 3 CDFIs. And then there's the FinTech companies that you can go online and you might be able to qualify if you're an existing business based on an algorithm, and you could be making a payment on a daily basis. And that interest rate on there isn't shared with you. It is generally just showed how much you pay back, how many days you'll pay it back, and the fact that you pay it every day. So you have to calculate the interest rate yourself, which we have a tendency of doing around here. So then what does an underwriter analyze? They're going to analyze to see if your business, based on this loan amount, project a payment into it, is going to pay off the particular loan. Way too often, and the underwriting process can include an opinion based on how successful your management skills are, how successful the market is going to be, and what is going to change 5 or 10 years down the road. 5 or 10 years down the road, if you have a 10-year loan, lenders want to know what's going to be happening in 2034. Dang, we're all going to be 10 years older. Bummer. But a lender is not going to look at it that way. They're going to look at it and say, gee, are they going to be able to pay this off for 10 years? So other things that they like to do is they like to mitigate risk and maybe look at some of the conditions. So lending is all about mitigating risk and about charging interest rates that are based on the risk that they assume. Small business loans are not the, least risky things on earth. That's a given fact. And then get into other things. Underwriters might, as far as conditions, they could make a loan based on a condition. One of the conditions we see, for example, is say you have a retail business. We'll go back with maybe a fast food business. And you lease your particular building, and your lease is only leased for 3 years, and you're seeking a 10-year loan. Well, they might make the loan based on the condition that you secure that building for another 7 years. So you are, risking 7 more years of that particular loan, or risking 7 more years of payments that you are due if something were to happen in that business. Now, a lot of people will go back and they will get, if they need a 10-year loan, they need a 10-year lease, they'll get a 5-year lease with an option for another 5 years. Conditions are all specified. After 5 years, everybody's happy. They exercise the option. As far as the lender goes, you have actually secured that condition by having access to 10 years of that property. So we mentioned a little bit about business plans and business planning. I think we got to talk about it because I think it's relevant in pretty much most loans. You can get by with a simple description in some. You can get by with a 10-page or less business plan for a smaller loan amount as it goes up, unless you have a lot of really historic cash flow that can be demonstrated by tax returns, where sometimes a description will get by. You're going to need to have a good business plan. And a lot of the trends that have been happening in business plans is we're seeing a lot of options to business plans. So whereas we see a business plan, we're now seeing pitch decks that are being actually presented to lenders. Pitch decks are usually used for equity, for individuals that want to invest in a particular business. But they are also actually being used also in the lending game right now by some small businesses, and lenders are fine with that. You'll see the business model canvas, and the canvas is used again. Oftentimes we see it with innovative technology startup businesses and others. We used it for a long time here at the SBDC back in the last decade. Really great concept, great way of going through it. It just depends on what your lender really wants to see. Sometimes you'll do a canvas and it's good to get it started and to use it as a basis for a business plan, but sometimes your lenders won't accept the canvas. So, and then always start with a loan package and application and build on that particular relationship. A lender's going to want to see that you have an introduction or a history or there's a need for your particular business. They're going to want to see some market information and market strategy. They want to know that you know your customers. Do you know your customers? Are you going to be able to sell to them, market to them? Do you have good management, and are the financials there? At the SBDC, you might see our toolbox on a lot of these webinar Wednesdays. And the one in the right-hand corner, Live Plan right up here, is an outstanding resource that SBDC clients can utilize with a particular advisor. And you can't live on it, but you can stay on it long enough and get your plan going and get your live plan going, generally at no cost to the particular client. So that's an option. And what do I want to see ideally in a business plan? I really like to see a concise snapshot of that opportunity. And I really want a business owner that's going to be able to understand their customers and the market that they operate in. And oftentimes, I think it's beneficial to look past the immediate need. You might need $50,000 now, but if you're thinking ahead and 18 months down the road, you're going to need another sum of money, then let's try to get this paid down and try to move past that particular need, or even borrow more money at this particular time so you don't have to do it in 18 months. You need clean financials that make sense, that have assumptions. The assumptions detail what's in the financials, and it needs to be clearly written by the business owner. Don't go to a lender and say, where can I have somebody write a business plan for me? That would be what we say around here is no bueno. Okay, so here's a little bit of the startup. And a lot of times, you're just basing on a startup business, you're basing everything on the best guess scenario. You're basing it on assumptions, and you're saying what it's going to be. I got news for you. It's going to be substantially different in many, many, many occasions when you get going. So the business model canvas, and going through the canvas, there was our consultant guide that we used, 9 boxes that we won't get into, just showing it for illustration purposes. But, jumping into some of the lending resources, they're going to be you need to know. And this will be probably an outstanding place for us to end today and take questions. But really, if you can get an SBDC lending checklist, like I say, ours is being updated at this time because it does change. There's an amortization calendar. You see the calendar.net. And that is shows you, if you put in 2 of the 3 variables, what your interest rate will be. There's a business planning template that's a great resource. Live Plan is a wonderful program. Projections template, working with a financial advisor to work on your projections. You can go see what your credit report is on Annual Credit Report and other sites, but annualcreditreport.com, and also talk to your SBDC financial. He'll get you going on some of these financial projections that look like that, and maybe some financial ratios that need to be identified, because the lenders are hard and fast on this particular number. So if their minimum is a 1.25 for your debt service cash flow, and you're lower than that, they're going to turn you down no matter what else you turn in, no matter what else is going on. So you have to look at this, and you have to work on some of these numbers before you get going. We showed you calculator.net, and it's something that I have shown before, but somebody came to me and they said, hey, my payment is $120.67. I got this online, this loan. I have payments that are for the next 20 months. Every day I pay $120.67. Saturdays, Sundays, holidays, my birthday, I even had to pay $120.67. You will pay this total in interest, $23,000, and that's the total amount that you pay back on this $50,000 loan. When you put in all these variables, since interest rate wasn't provided, we find that it's 49.49%. Yes, 49.49%. And then you say, dang, I'm paying 50% interest. I'm halfway through this thing. I want to pay it off after 10 months. So then what does your interest rate become? Well, your interest rate then becomes a lot higher. It becomes double, 99%. And 99% because you're paying for the interest the whole cycle of the loan. It's better just to spend the time and pay it off, save your cash flow, and help it for that particular timeline. And that's going to wrap it up. So let's see what we have as far as questions for today. Questions. First one's on an EIDL loan. Due to an unexpected interest or illness, I can't pay. How do I start to get the waiver or other help on the table? If you have an EIDL loan, go into your portal and start working with them as soon as possible, as soon as you know you're not going to make a payment. If your unexpected illness was a year ago, it's going to be probably worse off for you. But the sooner that you can start on that, and the sooner that you can get moving and explain your situation and maybe come up with a plan with SBA, the better off you will be. Why do lenders require a personal guarantee for an SBA guaranteed loan? And what happens if the business defaults? So lenders will require a personal guarantee by most principals in that particular business. And it is generally, I don't believe it's a requirement of SBA, but I think it's a require for a lot of the banks that make the SBA guarantee loans. I could be wrong on that, but I don't think so. So the SBA guarantee loan will oftentimes come with a personal guarantee. And so literally, it's something that you need to be prepared for about every time you borrow, is that you're going to need to guarantee that loan. So the event, if the business defaults and there's not sufficient collateral to pay it off, then the guarantee can kick in, the personal guarantee. So those are some of the things that you really need to get up front and talk to a lender. So thank you for that particular question. Okay, not seeing any other questions. Going through the chat box really quick. Good afternoon. Like getting the greetings in and out. Getting into this. Oh, Maureen's got a lot of good stuff in here. The employee retention credit. She has information on some of the programs that are offered and information on the YouTube channel. How to receive no-cost consulting if you're in Kern Inyo or Mono County, right there through the SBDC. See some other things in here, and going to set up some meetings. You want meetings? I got time after this thing's over. So the hardship link is the very last one that Maureen put in. That's a good place to go, and go to there if you don't want to go through your portal, but go through that particular hardship link, annual credit report, and that's about it. Okay, this could easily be 2 or 3 different webinars. There is so much to this, but I really think by having and engaging both, you know, the training aspect, getting the basics, and then working with an advisor is the best way to go on this. We're going to have a lot of financing topics come up in the next month or two. You know, spring is for funding and growing that particular business. We'll have topics on other loan programs. We'll have topics on crowdfunding. We'll have a lot of good stuff and examples on how you can get money. We'll get the alternatives out. There's a lot of alternatives, a lot of money out there. So get out there and get that particular slice of your pie. And that's going to wrap us up. So for our producer, Maureen Busher-Dang, I'm Kelly Bearden. We'll be back next week with webinar number 312. Everybody have a great week.